So welcome to the video, and we're going to start off jumping straight into it. So this is the conceptual framework. So the conceptual framework specifically referring to the 2018 revised version, and its purpose is essentially to assist the International Accounting Standards Body to develop IFRS standards, to assist preparers in developing consistent accounting frameworks, and to lastly assist all parties in understanding and interpreting standards such as myself. The objective of financial reporting. So, the objective is essentially to provide financial information about the reporting entity that is useful to existing and potential investors, lenders, and other creditors in making decisions relating to providing resources to the entity. So, I mentioned a few things such as the users, information, returns, and stewardship. So the users essentially they rely on the financial information contained in the financial reports, and they make estimates of what the value of the company is. Then information, this is essentially the financial information that is not primarily intended for management and regulators. Then returns are essentially the entity's economic resources, the claims against the entity, and the changes in those resources and claims. Then lastly, stewardship. This is an important concept because it essentially describes how efficient or effective management has discharged its responsibilities to use the entity's economic resources. Then moving on to another important concept, which is accrual accounting. Accrual accounting essentially it depicts the effects in the periods in which effects occur and not necessarily in the period in which the cash flows occur. Qualitative characteristics of useful financial information. There are two. There's fundamental and enhancing. So let's start off with fundamental qualitative characteristics. So fundamental characteristics include relevance and faithful representation. Relevance is essentially saying that information is capable of making a difference to the decisions made by the users. Then faithful representation is essentially saying that information faithfully represents the substance of what it purports to represent, essentially saying that it's complete, neutral, and free from error. Then the second one, enhancing. Enhancing has four things. There's comparability, where you say that similar entities and different periods of time can be compared for the same entity. Then verifiability, this is where you verify information based on information reported. Then timeliness, this is essentially that information reported timely and that all the information is less useful. And lastly, understandability, this is where there are clear and concise reporting that is occurring that knowledgeable parties can understand. And for both a fundamental and enhancing, you need to keep the cost constraints in mind. You need to consider the cost versus benefit. Essentially, does the cost of doing this bring out the benefit, essentially? Then I also mentioned faithful representation. There's more to faithful representation, such as the substance over form. This is where economic substance of an underlying economic phenomenon is normally the same as the legal form. Prudence, this is where you exercise caution when conditions are uncertain. And they don't allow any overstatement or understatement. Thus, you are supporting neutrality. And lastly, measurement uncertainty. This is also something you need to mention. Essentially, measurement uncertainty increases when the monetary amounts cannot be observed directly and they need to be estimated, which doesn't prevent it from being useful. It just affects whether sufficient faithful representation is achieved. Financial statements and the reporting entity. So it's important to know what is reporting periods, what is going concern, and also what is a reporting entity in itself. Starting off with reporting periods. So reporting period is essentially that Financial statements are prepared for a specific period of time, and they contain info on the position and performance of essentially having comparative information, forward-looking information, and also keeping track of subsequent events. The going concern is essentially an assumption that the entity will continue for the foreseeable future. And lastly, reporting entity. This is essentially an entity that is required or it chooses out of its own will to prepare a financial statement. It may not necessarily be a legal entity. It could be a portion of an entity or comprise of more than one entity. And it's also good to know what is the difference between consolidated, unconsolidated, and combined financial statements. Consolidated essentially means that it provides info of both the parent and its subsidiaries as a single reporting entity when the parent has control over the subsidiaries. Then unconsolidated generally means that it provides info on only the parent only. Then lastly, combined, this essentially it provides info of two or more entities that are not linked by a parent subsidiary relationship. Elements of financial statements. So this is probably the most important one and also my favorite. So elements are essentially the entity's economic resources, claims against the entity, and changes in those resources and claims. And they're essentially five elements that you need to be aware of. The first one is assets. An asset is a present economic resource controlled by the entity as a result of past events and is a right that has potential to produce economic benefits. So there are four elements that you need to be or look out for assets. There's rights, potential, control, and past events. For rights, you just need to identify the right. It could be a contract or ownership that brings about that is the right. Then potential, it doesn't have to be certain or likely. It just has to have potential of happening. So this way you'd need to disclose if it has low probability or not. But yeah, it doesn't need to be certain or likely. Then control. Control is essentially the present ability to direct the use, obtain the benefits, and prevent others from doing the same. This way you might also need to look into the principal versus agent, but we'll look into that in future videos. Then lastly, it's past events. This way you identify the event that resulted in the rise of the right. Then moving on to the next element, liability. A liability is a present obligation of the entity to transfer an economic resource as a result of past events. And an obligation is a duty or responsibility that the entity has no practical ability to avoid. And similar to assets, there are a few elements that you need to look out for. For liability, it's obligation, potential, and past events. Obligation, it can be legal, constructive, or conditional on the future actions of the entity itself, and an assumption that is made that the entity is operating on a going concern basis. The second is potential. Again, it doesn't have to be certain or likely, as long as there's a chance. This way you also need to disclose if there is low probability. And lastly, past event. Again, similar to assets, this way you identify the event that resulted in the rise of the obligation in the first place. Then the third element is equity. Equity is the residual interest in the asset of the entity after deducting all its liabilities. Then the fourth one is income. Income is essentially increases in assets or decreases in liabilities that result in increases in equity, other than those relating to contributions from holders of equity claims. Then the fifth and final one is expenses. Expenses are essentially decreases in assets or increases in liabilities that result in decreases in equity, other than those relating to contributions from holders of equity. So essentially it's the opposite of the definition of income. Then there's also a few things you need to keep in mind. For example, the unit of account. A unit of account is essentially the right or obligation or group of rights and obligation to which the recognition criteria and measurement concepts are applied. So this can be that the entity needs to define this one for themselves, and the unit of account must result in the information being both relevant and faithfully represented, thus making it useful. There's also another concept which you need to know, which is executory contracts. These are contracts that are equally unperformed, and it establishes, or rather, it's established that a single asset or liability for the inseparable combined right and obligation to exchange economic resources. So that's essentially the definition. And here, you need to establish combined rights and obligations to exchange economic resources that are independent and inseparable and that constitute a single asset or liability. So the performance targets, or rather, it triggers the recognition, and the onerous contracts need to be recognized. Recognition and derecognition. So recognition is essentially the process of capturing for inclusion in the statement of financial position or the statement of financial performance an item that meets the definition of asset, a liability, equity, income, or expense. So essentially here they need, or rather it must meet the definition of an element, and also it needs to meet the recognition criteria. So what is this recognition criteria? It's essentially saying that information that is useful, meaning that it's both relevant and faithfully represented. So starting off with relevant, here you need to look into the existence uncertainty, and for this one, is essentially saying that, or rather looking into the uncertainty on the elements of existence that makes the information to not be useful, thus making it fail the relevance criteria. So if it has a low probability of inflow or outflow of economic benefits, the definition could still be met, but the recognition would be questioned because there is low probability. And in this case, you would just disclose it. Then the second one, faithful representation. This way you look into, what is this? Yeah, you look into three things: the measurement uncertainty, the recognition uncertainty, and the presentation and disclosure of the item. So with measurement uncertainty, you're just questioning if it is free from error. For recognition uncertainty, on the other hand, you question if there is an accounting mismatch. And lastly, for presentation and disclosure of the item, this way you question if all information presented and disclosed should be useful or is useful. Then the other aspects to consider here is essentially the cost versus benefit that I mentioned earlier, and also the matching principle. This way you match the cost with the relating income. And it is not an objective of the conceptual framework, it's just something you need to consider. Then lastly is derecognition. We're already looking to recognition, so now we're going to look into derecognition. So essentially it's the opposite. It's the removal of all or part of the recognized asset or liability from the entity's specific statement of financial position. And this happens when it no longer meets the definition of the element. For assets, this could be when the entity loses control of all or part of the asset. For liabilities, it's essentially when the entity no longer has a present obligation for all or part of it. And here, the possibility of an asset's associated gain or loss would also need to be recorded as an income or an expense. Measurement. So here we're going to look into the measurement basis for assets and liabilities. So starting off with historic cost. Historic cost is essentially the price that you bought it for, and that's the price. Then fair value. The fair value is essentially the price in the market. So how much is it trading for in the market, an open traded market? That's the fair value. Then the value in use. This is essentially the value that you can attribute to that specific thing or asset if you used it. Then the current cost. Essentially, the current cost is the cost of an equivalent asset. So let's say I have a bottle. How much is that bottle or a similar bottle? Then for assets and liabilities, you can use either one of the two, but as long as you remember the fundamentals of what they mean, then you should be okay. For example, the differences here with assets and liabilities is that for assets, you may use the value in use, But for liabilities, you can't use that. You have to use the fulfillment value. So this is again entity specific, and it reflects the current expectations of the either the market or the entity itself. Then also the current costs. For assets, the current cost is the cost of an equivalent asset. Then for liabilities, the current cost is essentially the cost that you have received to take on an equivalent liability. So equivalent liabilities, for example, it could be a bond, it could be a loan, where you essentially use a similar bond or loan to know the costs. So there's other factors that you need to consider here. For example, the relevance and the faithful representation. We've already looked into them, but essentially for relevance, you have to consider the characteristics of the item to determine its sensitivity to market fluctuations and consider contributions to future cash flows to determine if it flows directly or indirectly to the entity. And also for faithful representation, this way you consider any measurement inconsistencies that may lead to accounting mismatches and any measurement uncertainties that may require a different measurement basis to be used. For example, if the inconsistencies are too high, you might want to use another measurement basis that is more stable. And again, you can also look into the enhancing qualitative characteristics and also the cost versus benefit. There are many other things, but this is just what we will focus on for measurement. Presentation and disclosure. This is a short one, and essentially you need to remember that presentation is in the face of the financial statements and the disclosure is in the notes. So the presentation is like a summary of everything that's happening, and the disclosure is where you go in depth, where you tell the users what actually happened, or rather you tell them what actually happened in greater detail. And for disclosure, essentially we're looking for effective communication. This can be either you telling them about the results of the relevance or the faithful representation of financial statements. This way you avoid boilerplating. This way, like, that disclosures need to be entity specific. Don't mix them up with anything else. This way you also look into the classification of assets, liabilities, equity, income, and expenses. And for our cases, we don't do any offsetting. We're going to look into that later. And you essentially, this is a balance between aggregation and disaggregation. And last but not least is the concept of capital and capital maintenance. So what is capital? Capital is the financial resources that are used to fund operations and growth. There's a financial concept and a physical concept to capital. The physical concept is essentially that production capacity at the beginning versus at the end of the period. And the financial concept of capital essentially saying that capital less any net assets or equity. And for this one, it is maintained if the net assets at the beginning of the period are equal to the net assets at the end of the period after all distributions and contributions. Yeah, and that was the conceptual framework. I hope this was informative. I hope it was entertaining. And most importantly, I hope it was simple. Thank you very much. See you in the next one.